Okay, thanks, Jim, very much for your kind introduction, and thank you all for coming. It's an honor and a genuine pleasure to give the Martin Feldstein lecture, especially the first one. Marty's a good friend. I admire him greatly for many things, but since we're all economists, for his insistence on using economic theory and results to improve people's lives, and I've seen that in many, many ways. And, but also to get involved in the fray, whether it's President Reagan's CEA or it's President Obama's task force, and also political campaigns, et cetera, like that. I always remember this, that I have a tie. It's called "Democracy is not a spectator sport." And I think that really holds for economists as well. So it's an honor and a pleasure to be here. Jim gave me pretty clear instructions, and I wrote them down here a little bit to make sure I didn't depart too much. He actually mentioned them a little bit in the introduction. The Feldstein lecture will address an important question in applied economics with application to policy. It also will not make any policy recommendations. So I'm going to put this up here at the top, especially during the Q&A, to make sure I don't drift into the recommendations category. What I'd like to do is, in terms of keeping with that overall goal or strategy, is to think of this as a particular purpose, if you like, for the Feldstein lecture. I see I have a warning about a virus. It's okay. It wasn't a gimmick. It's part of a teaching technique. Don't worry. But actually, I have to say, Jim, one thing you said about the grape, it wasn't actually a grape. It was a raisin. And some of you may remember, some of you older people, there used to be a wonderful ad, TV ad for California raisins. And it'd be cartoon characters who look like California raisins, and they dance around the stage to Marvin Gaye's You Heard It Through the Grapevine. And it's really a terrific ad. So I had the idea one day that I would use this in my class to demonstrate government intervention and how it leads to more intervention, because this ad was designed to increase the demand for raisins and therefore reduce the cost of a government subsidy for raisins. So that was the whole idea. But it's, I remember the first time I did it, it was kind of like a scary thing to do. How crazy can this guy be? But it worked out okay. I don't do it anymore, that's for sure. But to get serious, so what I'd like to do is focus on macroeconomic policy, that's my field, and look at policy evaluation during the period, really since the fall of 2008. It's like since the panic period following the crisis. And I want to compare policy with some counterfactuals. And since the challenge of policy evaluation is to think of what the alternative was in terms of policy. It's very easy to say, oh, that was a good policy, that was a bad policy, this wasn't so good, this wasn't so bad. But in macro, I think especially all fields, quite frankly, you need to think of a counterfactual in order to evaluate policy. So a lot of this lecture actually is trying to become more formal about evaluating policies that we're still learning about using counterfactuals. And as you'll see, I'm going to look at counterfactual for monetary policy, and then I'm going to look at a counterfactual for fiscal policy. Each of those are sort of broad subjects in some sense and involve a lot of sub-counterfactuals, which I'd like to address. So in some sense, this is a massive undertaking to think about an evaluation of monetary policy and fiscal policy since the panic of last fall. Although every day you hear people pontificating about this was good and this was bad. But I think in principle, from our perspective as economists, it requires a lot of careful study. Now, it's real time, of course, and that's why I use the term, because the crisis is ongoing. And I want to emphasize real time here is, in a sense, as a unifying theme. I think right now with this crisis, real time analysis is essential. We have things changing every day. We have new policies being proposed. Presumably, they should be based on analysis of things that are going on. And I would say, based on my own experience in the last few years, it's tremendously interesting to study this. It's a tragedy we're having this crisis, but you can't think of a more interesting set of data to look at and you've never seen these kind of policies before, so it's an enormous amount of things to look at. I think it also raises questions about research. I'm going to emphasize we need more high-frequency data. We need to figure ways to do our policy evaluations. And from the point of view of macro, I think it really is different. And I want to spend a couple minutes on that subject of why is real-time analysis, like I'm going to discuss, different from what we have normally done in macro. I'm going to use a couple of examples. First one is from my own work many years ago, where I tried to evaluate different types of monetary policy rules. And the idea was to see whether, say, a fixed growth rate rule for the money supply was better than a feedback rule or was better than reality. And so that wasn't done in real time by any means. In fact, this paper published in 1979 focused on roughly 20 years from 1953 to 75. So that's completely not real time. It's partly publication lags, but partly looking at history, if you like. And for that work, I used a graph like this, which I think kind of illustrates this concept of counterfactuals. This is a graph which shows you a policy trade-off, macro trade-off, between how volatile the economy is in terms of GDP on the vertical axis and how volatile inflation is on the horizontal axis, price stability, inflation stability, the two main factors we look at a lot, output stability and price stability. And in this picture, there's this trade-off which can be calculated, but it's optimal to be on the trade-off because you'd like to have as low amount of both as possible. But you can also see the counterfactuals. One counterfactual is the constant growth rate rule, and of course you see actual US performance. So in this case, the constant growth rate rule looks actually a little better than actual performance, not quite completely dominating, but since you got such a much larger amount of reduction in output variance, if you like, it's preferred. So that's an example of how macro research has, and the same lines, Marty and Jim Stock in 1997 published a paper which they looked at different feedback rules for M2. And again, they looked at the period 59 to 92, not exactly real time, but methodology being quite similar. Steve Cicchetti and some of his colleagues published a paper in 2006, the same kind of strategy. They're looking to see to what extent the great moderation could have been due to monetary policy. Looked at 24 countries. Their sample period was 82 to 98. Again, not exactly real time. And then Ben Bernanke in a paper he published before he became chairman, he has the same kind of concept. He's looking at what the cause for the great moderation was. So he uses a diagram like we have up here, same picture essentially, and says, was the improvement in performance, that is movement towards the origin to lower variability of inflation and output due to monetary policy or due to some structural shifts that moves that trade-off curve to the origin. So again, it's really longer term kinds of considerations. What kind of policy would work well on average over periods of time? Not exactly real time. And so that's kind of some of the way it's been. Now actually, Lars Svensson just found out recently is doing something more in the direction of what I'm talking about here. And that is to see if you could modify some of those techniques to actually do real time. And so his paper has a picture similar to the others. Here's what it is. But on the vertical axis, you don't have the historical or theoretical variance of GDP on the vertical axis or inflation on the horizontal axis. You have the forecast by the central bank. So in this case, what he's imagining is the central bank, in his case the Riksbank, is considering different types of paths for the interest rate, say back in February. And you can see what the different paths deliver based on a forecast of inflation and output for the near future. So in that sense, it's getting closer to a formal kind of policy analysis, but really much in real time. So Lars' paper, for example, published, I think in March, is evaluating Riksbank policy in February using this. So it's really, I think, reflecting what I think is a need and a trend to find ways to use these techniques, which have been very common in current analysis. I also want to say that when I think about my role here in terms of evaluating policy. I want to focus on only one part of the financial crisis. I think it's important to emphasize that. I think of the financial crisis as best thought of as so far 4 stages. Who knows what the 5th will be, or the 6th or 7th or whatever. But the 4 stages I think of as the years leading up to the crisis. So you look at the root causes of it. I happen to think through my real-time policy evaluation research that there was a great deviation in policy, very low interest rates that generated the excesses, if you like. I'm not going to talk about that today. And then you have the period from the flare-up in August of 2007 till September 2008, where things seemed to just get worse and worse, if you like, at least did not improve with respect to the stability in the financial markets. And I blame that on, if you like, a great delay in the policy responses using a kind of real-time policy analysis. I'm not going to talk about that today either. And then finally, you had this incredible panic that we all know about. A couple pictures of the panic. This is the S&P 500 index. You see a huge drop there is in the September, early October period. I have some dates there for various things that happened. You have the TARP, the Lehman bankruptcy, et cetera. So there's a huge issue here, still real time, about what caused this. Was it Lehman? Was it scare, policy scares or whatever? So that's, if you like, the third aspect, the panic, and I actually think it was due to some scare by policy, so maybe that's the great scare, but I'm not going to talk about that either. What I am going to talk about is this last point, and that is the post-panic period. So if you like, I'm going into some new ground for this lecture. And I'd like to try to examine, if you like, policy during this very recent period. I think it's very important to try to understand it as best we can using the best techniques and the best data we have. Okay. Now, the first thing you need to do policy evaluation is describe the actual policy. Okay. So it's not easy. It's complicated. So I'm going to take a few minutes on what the actual policy was. So first of all, during the week of 17th of September, reserve balances, the reserves that depository institutions hold at the Fed, increased, actually for the first time, above the level required to keep the federal funds rate on target. So I'll show you a picture about that in a minute. At that point, the federal funds rate was at 2%. Okay, so this was, first of all, first point here, this is quantitative easing in the sense that reserves rose above a level required to keep the rate at a certain point. Interest rates were not at 0 at that point in time. Interest rates were at 2%. So frequently you will hear quantitative easing occurred because the interest rate hit 0. That is not the way this happened, you can see. So it's a different kind of characterization than you frequently hear, but I'll show you that that's actually what happened. I think you'll see that reserves were increased for a particular reason, that it was to finance some loans, first through a new loan facility called the Primary Dealer Credit Facility, the PDCF. So the Fed was making those loans. It had to finance them. It financed them by money creation, by crediting, through the deposits of the banks at the Fed. And then, of course, also to purchase securities of various kinds. And I think it's also important in terms of understanding this, and it deserves research, but I'm pretty convinced that these reserves were not increased, as frequently people say, to accommodate a shift in the demand for money, increased demand for money or a decline in velocity. This is an exogenous supply increase in reserves. And so we need to be sure about that as well, but I think I could be clear about that. And then, of course, reserves continued to increase through the end of last year. As additional securities and loans were made. This actually drove the interest rate to 0, as I'll show you in a minute. And the FOMC ratified those declines to 0. And of course, reserves have remained elevated ever since. Now, here's the pictures that describe that slide. Okay, so first of all, these are the reserve balances that I mentioned that jumped sometime during the week of September 17th. We don't have daily data, unfortunately, to know exactly when. At least we don't have it outside the Fed, but it's sometime during the week of September 17th. And you can see reserves jumped from a level which was being used to monitor the interest rate, started moving and got up to 800 and has been actually at that level pretty closely. We don't know where it's going, but it's hovered around that level with some ups and downs ever since. These are just another way to visualize this shorter period of time. You can now see if you look closely that the jump, first jump there, which is at the time it was huge. It was $60 billion on September 17th. That was to provide for the loans through the primary direct credit facility, as far as I can tell, although there's no record of why that decision was made anywhere. And so then you have reserves increasing rapidly. The bar charts show you the weekly averages, the black line, the end of Wednesday, end of the week ending Wednesday. And you can see they go right through most recent data at this high level. Okay, so just to, now some more visuals here. Got a couple visuals. If you like colors, these are great. But these try to give you a sense of the purchases that were made that were financed through that reserve creation. Okay, so the thing at the very bottom, and by the way, the scale starts at 400 billion, so just cut off at the bottom. But the very bottom is the Treasury securities. If you go off to the very far right, you can see those starting to increase, the very bottom one. Those are the recent purchases of medium-term treasuries by the Fed. That's what that thing is over at the end. You have the term auction facility, which was created earlier in the crisis but expanded right after the panic dramatically. That's the green line. You also have what's labeled here just private portfolio. I'll show you that in a minute, but that's expanded quite a bit. You have also the loans or swaps to other central banks. That's the yellow one near the top. And you have some just other assets. It's a small amount at the very top. So you can see these are things that were created, and the reason for the reserve increase was to finance the purchases of them. The category, which if you can see it, the purple one, private portfolio, here's the details of that one. And so what's in that private portfolio are the Bear Stearns securities, the AIG, some of the AIG securities, but most significantly, the commercial paper funding facility, which was generated during the panic, a very well-received program to get the commercial paper market moving again. And then the mortgage-backed securities purchases, which is very large now, and it's started since the beginning of this year and has expanded dramatically. Of course, those need to be financed through reserve creation as well. Okay, so that's basically the reason for the expansion of the balance sheet. Now, the interest rate decline, remember it started at 2 and came down to 0. I want to just show you that in this picture. Okay, so what this picture shows you is the effective federal funds rate during this period. And you can see it was well above 0, 2%, during this expansion of reserves. So again, this is not a sense in which the interest rates hit 0 and the quantitative easing began. Quantitative easing effectively drove down that interest rate towards 0. You can see the pattern very, very clearly, it seems to me. And of course, by the end of the year, the interest rate was between 0 and 0.25. Now, just a little bit of decision-making timing on this, so we can think this through. I've listed the 3 FOMC votes during this period about the federal funds rate. And all this is trying to show is that each of those votes occurred when the rate was already below what they were voting to bring it to. So for example, on October 8th, the FOMC voted to cut the federal funds rate from 1.5 to 1.5 from 2 to 1.5 from 2%. But for the 2 weeks ending that day, the funds rate was already 1.45%. Then on October 29th, they vote to cut it to 1 from 1.5. The rate was already below that, and so on. So this is essentially a ratification of rates that had already been determined. Okay, so that's the actual policy. And the question is, was that a good policy? We don't, let's try to, how would we evaluate that policy one way or the other? Well, got to choose a counterfactual. So not easy. So one general counterfactual, which would be what I would have chosen before this, if you like, is to think about what would have happened, is fairly standard. And that is counterfactuals when the optimal interest rate, Taylor rule, whatever you want, hits 0, and let's just say slightly positive, because I think something like 0.25 makes more sense, then the trading desk, its objective is to keep the level of reserves consistent with that 0.25 or 0.125 or whatever. And also on the side, make sure the growth rate of money does not fall. So in a sense, it's like a constant growth rate rule. At least it focuses on the money supply, but it doesn't expand the reserves at a tremendous rate. It's quantitative in the sense the focus is on reserves, bringing reserves to a level consistent with the 0.25, but it's a much different type of zero interest rate bound policy than was followed. In some sense, this is how quantitative macro monetary models are simulated, such as the ones that Volker Wieland presented here yesterday. Also, it seems to me it does avoid the Great Depression or Japan lost decade problem because it doesn't allow money growth to decline. You would not try to keep the federal funds rate from going below 0.25 by reducing money growth. That's not what is meant here. Now, I think this is a good way to think about it, but quite frankly, I think in designing counterfactuals practically, it's probably better to get a little closer to what the actual policy was. And so that's really what I want to do. I don't want to go to that extreme. I want to consider a counterfactual which is closer to the actual policy. And so for that more specific counterfactual, I want to just do 3 things differently than the actual policy. So these are some of the sub-counterfactuals that I'm talking about. The first is that there are no mortgage-backed securities purchases. You saw that in the picture. Rather than $500 billion is where they are about now, and are expected to rise to $1.2 trillion. Okay, that's the first. Just don't do any of those. Second, don't have the term auction facility. That's $0 billion, rather than something that rose to as much as $500 billion. The term auction facility is the way that banks can borrow from the Fed without going through the discount window, through an auction, a special thing set up in December 2007. And the third thing is no purchases of medium-term, long-term Treasury securities. So that's 0 as well, rather than up to the 300, which they can do. It's now approximately 200, I understand. Okay, so that's kind of like a more modest counterfactual. That's what I want to think of here as my counterfactual, if you like. Okay, so what does that do? Well, let's first look at the charts. So that's how things were originally. With reserve balances. It's a huge jump. This is how they would be with the counterfactual. Okay, so 2 things. If you look at those, it's about half as much of an increase, so it's substantial. They wouldn't have started to increase it. They would have been at a lower level for a while because the Fed would have been lowering the federal funds rate without expansion of reserves. And perhaps most important, they're already back to normal, if you like, back to roughly $8 billion, $8 to $10 billion is where they were before this expansion, already back. So the questions that you sometimes hear that Rick Mishkin was talking about this morning, the questions about the balance sheet, independence and all those things, they'd be gone by now if this was the policy. And they wouldn't be increasing if this was the policy, unless there was suddenly a big increase in demand for AIG type bailouts or something, which I'm assuming there's not. Okay, so that's that picture. You can also look at it with respect to the just this little section here with the bar charts. This the same picture, if you like, but you can see how much different it is. This is more like a classic expansion of reserves on a temporary basis because of the crisis, which are then pulled out of the system as fast as reasonable. And then here's what it, if you like, does to those charts over there. This is the things that cause the reserves to increase, the purchases of all those securities. This is what it would look like with my counterfactual. Okay, so what you're missing, you see the TAF loans disappear. That's the green that goes away. And the private portfolio gets much smaller, what I call private portfolio purchases of mortgage-backed securities and AIG, et cetera, like that. Okay, so that's much smaller. Okay, so that's the biggest issue. Note also, though, that towards the end you see securities going up again. Those are Treasury bills, because this counterfactual reduces the purchases so much that the Fed actually comes in and does regular open market operations through buying Treasury bills, not long-term securities, in order to keep the reserves from going below the level consistent with the 0.25 target interest rate. Okay, and then finally, recall this was the private portfolio, and the big bulge there is the mortgage-backed securities, and this is what it's going to look like with the counterfactual. Basically just chopping off those mortgage-backed securities. Okay, so the question is what would this look like? I'd say, first of all, the interest rate's not going to be any different, right? The interest rate path is the same in the factual, in the actual, and in the counterfactual. Put that aside for the time being. But what's going to be a lot different are these purchases programs, okay? So the policy now has to look at each of those. This alternative, you have to think, what's going on with each of those? How much different would the economy look because mortgage-backed securities weren't purchased, because the TAF doesn't work, because of no purchases of long-term treasuries, okay? So I've done a lot of work on these topics, and I'm going to summarize them for you here. So first, with respect to mortgage-backed securities. They were undertaken, those purchases, in order to reduce mortgage rates. Purchase mortgage-backed securities, increase the supply, you reduce the yield on the securities, and many people, it says almost conventional wisdom, is that this did its job. And the picture of that is here. This is the spread between 30-year fixed mortgage rates, as tabulated by Freddie Mac series, versus 10-year treasuries. It's because of the 30-year mortgages are paid back before 30 years. You use 10 years roughly as the maturity. And so that gives you your spread. And you can see that that did come down dramatically. And here is the picture of the purchases of the mortgage-backed securities. Okay, and so you can see they're jumping up right there about the same time, and they're going up towards the 500 billion. And of course, the timing is quite right. You know, it looks just exactly like what you think it should be. So you might just say, well, this did it. The question, though, it seems to me, is, first of all, if you just did a regression, it's not going to help you very much because it doesn't explain the rise in the spreads in the first place. It's sort of missing, why did that rise in spreads occur? So to me, I say, well, if this is going to be the explanation, I at least need to find a way to control for something that may be causing that rise and perhaps the fall independent of those purchases. So what that might be, what might you use for that purpose? Well, we do have one of the advantages of the CDS markets is there are CDS instruments on all sorts of things, including Fannie and Freddie securities. Okay, so the blue line is the CDS on Fannie Mae bonds. Okay, so that's kind of a measure, if you like, of perceived risk from these institutions during the period before they were officially part of the government, when they were just government-sponsored agencies with some expectation of government rescue or bailout. That's the blue line. Unfortunately, because of the demise of Fannie and Freddie, we no longer have the CDS on Fannie and Freddie. So the blue line stops at that point in time. Okay, and I wish some over-the-counter guys would be doing some CDSs on this, but they don't so far. I can't find any. So what I have here is the red line, and this is simply the spread between Fannie Mae bonds, the bonds that they issue to raise funds, and treasuries of similar maturity. Okay, so it looks like a pretty good relationship between the CDS measure of risk in some sense, so a plausible thing would be to simply take either a predicted value of the CDS or just take the spread itself, spread on Fannie Mae bonds and treasuries itself, as a measure of risk or perceived risk of Fannie and Freddie, and use that in the analysis of the spreads. Okay, well, not surprisingly, if you're looking at these charts very closely, that spread explains a large amount of the movement in the MBS spread itself. Just look at it. Let me go back to that's the spread, the MBS spread that we're concerned about, the mortgages. This is the spread between Fannie, Freddie is the same, borrowing in treasuries. They move very closely. So a statistical analysis, regression or whatever, which includes the red variable there and explaining that red variable, is going to do very well. So well, in fact, that when you include it along with the mortgage-backed securities purchases, suitably scaled or whatever, mortgage-backed securities has very small impacts, hardly significant. It's hard to get the right sign, quite frankly. But with the most reasonable regression, this is what we found. This is basically taking an estimated equation of the spread, 30-year fixed mortgage versus 10-year treasuries, and examining the counterfactual of what would have happened had there been no MBS purchases. And in this regression, there is an impact in the MBS purchases, but of course, it is very, very small, on the order of 10 basis points at the most, when you come towards the end of this. Okay, so this would suggest that not much different would have happened, if you just take the statistics, if the MBS purchases had not taken place. Now, there's lots of, I'm sure there's lots of reasons you can bring that this may not be the definitive answer. To some extent, my purpose here is to show that you need to do something one way or the other to prove what is the right answer. And I'm quite convinced here that there's something else going on than simply those purchases. The null hypothesis, of course, is that you have a term structure of interest rates, and supplies don't matter that much. So in some sense, the null hypothesis from finance theory, term structure of interest rates, even with risk, is that it's not going to have much effect. And so that's what the data seem to show. Okay, so that's the first thing. Second thing is the TAF. Okay, I'm going to try to go through this a little more quickly, but in some sense, a little more complicated. So this is only one picture for all this. This is the impact of the term auction facility. Well, first of all, the green line is just the term auction facility amounts outstanding during this period. And you can see how they started in, as I said, in December 2007, started to increase, and then were ratcheted up by huge amounts of the amount that could be purchased and the terms and the maturity, et cetera, and they rose to roughly 500 billion at the peak, now starting to drift down. The other two lines, the blue line in particular, focus on the blue line if you like, LOIS I call it, that's the LIBOR-OIS spread, the spread between I use three-month interbank loans, that's LIBOR, and OIS, the expectation of the overnight federal funds rate during those 3-month period. So that blue line, early in the crisis, I think was the best measure of the turbulence in the banking sector. In the fall of 2007, John Williams, colleague of mine, a friend of mine to the San Francisco Fed, and I did research on trying to explain the first little blip there in the blue line back in August of 2007. And we decided that among explanations, it was most likely due to a counterparty risk problem between the banks, not due to a liquidity problem. And one of our proofs of that was the red line. Red line is the spread between LIBOR and repo, basically unsecured credit, LIBOR, versus secured credit, repos. Repos secured by government bonds. And you can see since that moved so closely, our work really began before the panic, well before the panic, but it moved very closely so much that the term auction facility couldn't play much of a role. If you look really closely, the term auction facility started in December '07 and started to rise. And at that point, the LIBOR-OIS spread did come down. And so early on, there was some positive assessments of that the term auction facility was working in terms of driving down the spread in the interbank market. But the interbank market quickly deteriorated, and even though the TAF went up. Okay, so then finally through the panic period, you see that the LIBOR-OIS rose dramatically. I mean, I think I have reasons for why I think that occurred, but put those aside for a minute. You also have the red line moving up almost in parallel now. So at this point, there's absolutely no question that these, the LIBOR-OIS spreads, the turbulence in the banking market, has to do with counterparty risk, not just a broad measure of liquidity that would be provided through banks finding it easy to borrow from the Fed through the term auction facility. Okay, so this picture, it seems to me, shows pretty clearly that the term auction facility can't have much of an effect on, at least LIBOR-LAS, on this thing that the Fed would like to have lowered, LIBOR in particular. It does stand up to lots of econometrics, okay? So you can do econometrics this way, econometrics that way. So but I think the picture, in a sense, tells the whole story. There is disagreement about this, I should say, some other work that's been done. So it is ripe for research and study. Just for the purposes of this lecture, it seems that this picture makes it clear that the second sub-counterfactual, TAF, maybe we could have gotten away with too. And maybe come back to that. Okay, then the third thing, the Treasury purchases, the Fed purchases of medium-term treasuries. Okay, I'm just going to have one picture here. This is tough to test. Have done the regressions, but here's the deal. The blue line is the cumulative Fed purchases of long-term treasuries. You can see those moving up and presumably continuing to move up till they get to 300 billion. We don't know what happened to the program after that. But you also see the 10-year treasuries, which really the focus of these purchases. Remember the spread between the 10-year treasuries was the basis for that spread of mortgages, and so reducing treasuries would reduce mortgage rates, which is one of the reasons the Fed stated it wanted to do this program. When the program was announced, there was a good move in yields. You can see that over there towards the, right before the purchases begin is a sharp drop in yields. And so that was the announcement. There's no question, that, in my view, that came because of that announcement. But then yields started to move up quite steadily. They got as high as 4. They've eased off a bit now, as you know. And so clearly there's a real question here about the impact of this program just on a gut feeling. Of course, there's lots of things to control for. The economy strengthens, picks up. There's concerns about inflation. If you do just the timing of the purchases day by day, just to do deltas on the purchases and deltas on the rates, you can't find any effect. Now here it seems to me we got a lot of theory that's clear that should be suspicious about this having a big impact as well. You have the term structure theory. Supplies generally don't tend to matter after a few days. Surprises can obviously matter, but ultimately it tends to disappear. And it seems to me that's what you're seeing here. I mean, I would have been very surprised if you saw much else. But again, this requires an attempt, at least, to try to prove. I would say it this way. Someone's got to be able to show to me that this is working. Right now, I don't see it. Okay, here's the third thing. So all three of these, in some sense, have had the, at least by this analysis, by this policy evaluation, not had the effect that they're sometimes said to have had. So in this sense, the counterfactual I laid out, which I think has some appeal to it, in the sense we're off of the expanded balance sheet. Monetary policy is close to what it would normally be operating. There was an expansion of reserves for the emergency programs, the commercial paper market, et cetera. So it's not draconian in any way, shape, or form. So it seems to me this is something, a basis for saying that there are some alternatives that would have worked just as well and would be leaving us in a better situation now. Okay, that's the monetary policy evaluation. Fortunately, I've spent so much time on monetary policy. I don't have much time on fiscal policy, but maybe that's just as well, since I am a monetary guy. But let's talk about fiscal policy briefly. Okay. So here the question is, what should be the counterfactual? So one natural one, of course, is no stimulus packages, no big counterfactual discretionary packages. In other words, only use the automatic stabilizers, which, by the way, are not trivial, because the reason the budget deficit has increased so much already are the automatic stabilizers. It's really the reduction in tax revenues, which has been huge, and the automatic increases in spending. So one natural alternative is to think about, if you like, no stimulus packages whatsoever. Now, quite frankly, although people are trying to get out there and saying this worked and that worked and this didn't, it seems to me it's still too early. This is real-time economics where you really got to say, sorry, we don't have enough time one way or the other. But here's a preliminary look, if you like. Actually, the first look is just the 2008 stimulus package. And this comes from a paper I just gave at the AEA meetings in January. And this basically tries to look at the stimulus package of 2008. And what it does is show personal disposable income, that's the red line, from January 07 through the period of the summer of 2008. And it's got the disposable income jumping dramatically with the rebates, et cetera, that were paid out as part of that stimulus package. The blue line shows what would have happened without the stimulus package. These are data that the BEA collects. I think actually they deserve a lot of credit for trying to put these data together. They just come right out of the monthly reports. So you can get a good estimate of what the amount of the stimulus package. And then you have PCE below that, and you can see it's very hard to find any kind of a impact, if you like. There's no jump starting of PCE that I can detect here whatsoever. Now, it is important to try to use regressions and things like that, and in the analysis of this that I did do the regressions, and it's hard to find significant effects of the stimulus package here on PCE consumption, on PCE. Okay. Well, what about the second package, if you like? Well, here we go. I've taken, unfortunately, BEA is continuing to do its work in adjusting personal disposable income. And so at the upper right part of the diagram, you see personal disposable income moving very rapidly. So the last part is really a $250 payments to individuals. It's also the beginning of the Make Work Pay program, which is increasing income because those are tax credits to people. And so that's part of the stimulus package that's being passed. So without the stimulus package, personal disposable income would not be increasing so much, but it's jumped quite a bit. If you look back at personal consumption expenditures, of course you see the drop during the panic, which wasn't in the first picture. The panic of last fall was a real collapse in consumption. It's stabilized since then, but has not picked up. But there's absolutely no noticeable effect of this on consumption at this point in time. So it's too early to tell, but it seems to me we very much are in a, here we go again, situation. Not really surprising from the point of view of economic theory, the permanent income theory, which suggests the MPC would be quite low for these kinds of payments. And indeed, it's so low, it's hard to find it in these pictures at all. Okay, so real-time analysis, again, I think is useful. And I would say, to some extent, keeping out of the policy recommendation area for a minute, but this picture here would seem to me to have suggested, since it was available before the second stimulus package, would have suggested maybe that second stimulus package would not have been the right thing to do. But all we can do is continue to do our empirical work and present it to the policymakers, and they will decide. Okay, so they decided. The last thing here as about the fiscal package, stimulus package, is government spending. Okay, so I just looked at the reduction in taxes or rebates, one-time payments, et cetera. But let's talk a little bit about government purchases, and I want to refer towards the end here to some work I've done with Volker Wieland and John Kogan, and it's gotten a lot of discussion, but I just want to just go through the numbers here with you. This gives you the stimulus package by year, 09, 2010 fiscal year, the amount of increase in federal purchases, which is G in our models, purchases, and the amount that are transfers to state and local governments, and then the increase in the deficit. Roughly speaking, the increase in the deficit are for things that are not purchases or not transfers to state and local governments. For the purpose of figuring out how much of the increase to state and local governments is actually results in G, government purchases at the state and local level, we assumed a rule of thumb that that would be about 60% of the 48, for example, or 60% of the 107. So based on that, you get an estimate of government purchases in its effect, because that's what we're interested in here. And so what would be the impact of this plan on government purchases, And so here's the picture for that. Okay, so this was done before we got going with the stimulus package, so definitely real time. And the blue line represents the estimates that we got, our research, of what the stimulus package would be quarter by quarter, using the 60% assumption and making some other timing things, trying to get an estimate on a quarterly basis of how much government purchase would be increasing as a percent of GDP starting in the first quarter of this year going several years into the future. The red line is the impact using a new Keynesian model, actually a Smets-Vatters model, on GDP. Okay, so this is trying to just bring out the latest model and make the estimates. So the first thing I can say so far, it's still too early to tell many of these things, but one thing that's good is the estimates we used for the first quarter and the second quarter are very close to the payout rate. So there's really not a surprise, if you like. Things are going slower or faster than was reasonable projections would be. So that's good. Things, you don't want to complain it's too slower than was forecast. You might complain it's too slow or whatever, but it's not slower than forecast. So that's basically about right. And it seems to me, given that it's pretty clear that, at least from this kind of thing, that the impacts are not surprising, they're smaller than is observable at this point. So you'd only be getting 1.1% of GDP in the first quarter and 0.3% of GDP in the second quarter. And with all the other things that are happening, it'd be very hard to detect this in the data. But anyway, nonetheless, it seems to be consistent. And consistent with the view that these are not big impacts. These are impacts, but they're not big, mainly because you have the government purchases, which is really what we're thinking about here. I looked at the transfer payments before, but the government purchases are spread out over a long period of time. So this is having a small impact as well. Okay, so as you can see, I'm going to try to wrap up now, both my examination of the monetary policy and the fiscal policy in real time is leading to the conclusion that maybe these policies, evaluating the policies, thinking of counterfactuals in this case being no stimulus packages, are not having that big of an effect. And therefore that's the evaluation that I come to. Now I want to just conclude going back to my ultimate theme here, and that is, what about this whole idea of policy evaluation in real time? So what I think this is trying to show, and I don't want to say that my answers are definitive or the last word, but what I want to convince you is that this is the kind of thing that we should be doing in terms of evaluating monetary policy and fiscal policy. Unfortunately, it has to be done in real time. Our hope is that by doing the analysis, it'll affect the policies themselves. And no question, these are fast-moving events, unprecedented responses. The things I described with respect to monetary policy, unprecedented. The fiscal policy response, the size of these packages, unprecedented, completely new. I think from the point of view of the way policy gets talked about, you got this 24-hour news cycle, you got the blogs, terrific things. But in some sense, what happens is the first idea that comes out of somebody's back of the envelope calculation, if you like, sometimes that's the best one in the end, but not where I would end, becomes the word. It spreads around and that becomes what's happened. But that's not what we like to do in research as economists. We like to have a better, more thorough, careful analysis with the best data. That's what I think we should be trying to do as much as we can, despite its difficulty. And I quite frankly think that policy will depend on this kind of thing. I also don't think this is going to change with the end of the crisis. I think the way we've developed policies now and responses that could be used, even if crises weren't so big, those Federal Reserve policies, for example, could come out. I think as my experience with this in the last 2 or 3 years is that we have a lot of data. Bloomberg actually provides a tremendous amount of data on the financial markets on all sorts of CDS rates. So we got a lot of data coming out. A lot of it is high frequency. Of course, we have the capability of processing this data, which is miraculous. just getting these graphs up like this is extraordinarily extraordinarily helpful in terms of understanding. So I would say there's no reason to wait the long period of time like I showed you in my beginning slides of policy evaluation, whether it's my work or the work of Marty and Jim Stock I referred to, or Bernanke or whatever. It's really possible, I think, and I urge people to think of it this way. And in particular, Friedman and Schwartz, of course, analyzed the Great Depression 30 years after it was over. And I don't think we need to be doing that or should be doing that. I do think, just to finally conclude, that we can do a lot better here, though. One thing, I find the high-frequency data more and more valuable to assess what's going on. And of course, we have daily data for all sorts of financial variables, but we have very little high-frequency data for real variables, if you like. I think, too, if I'm going to go really back fast to my slides here, if you look at this period of the panic, is awfully important to try to understand what happened. There's a view that it all started because Lehman Brothers was not bailed out. There's other views that there was scares because of the government's responses. It had a huge impact around the world, like Musa showed you today. It stopped pretty much on a dime. It's bounding back in some other countries. What actually was going on there? I think you need daily data to really figure that out because the timing is very, very important. Could it possibly been Lehman Brothers, or was it speeches or testimony that generated it? So I think that's a task for some institution, not a policy recommendation, but it's something to think about. And then I think improved techniques. I mentioned Lars' innovative ways to think about real-time policy evaluation. I think there's a lot of econometrics that is possible here. And then finally, quite frankly, publication is important. Sometimes it's hard to get this kind of work published. So I think maybe we should establish a journal of real-time policy evaluation. What do you think of that? Anyway, thank you very much.